Welcome to our deep dive into the world of tax strategies used by the wealthy to minimize their tax burden. Now, before we start, let me be clear, we're not here to say these strategies are illegal. They're not. They're perfectly legal. And that's part of the problem, isn't it? It's like finding out your local supermarket has a preferred customer program where billionaires get to shoplift with impunity. Over the next few minutes, we're going to shine a light on the intricate and frankly infuriating ways the wealthy manage to pay less in taxes than you do, all while remaining on the right side of the law. We'll be looking at everything from offshore tax havens that sound like they're straight out of a pirate movie to something called a dynasty trust, which is either a really boring soap opera or a terrifyingly effective way to dodge inheritance taxes for generations. Spoiler alert, it's the second one. Let's be clear. Understanding these strategies isn't about envy. It's about understanding the system we live in. It's about asking ourselves if a system where these loopholes exist is truly fair, or if it's more like a carnival game rigged against anyone who isn't already holding a fistful of winning tickets. So, you know how you keep your money in a bank? Well, the super rich, they like to send their money on little vacations, tropical vacations, to places with names like the Cayman Islands or the British Virgin Islands, where the weather is lovely and the tax rates are practically non-existent. These are called tax havens, and they're about as subtle as a flamingo in a snowstorm. We're talking about countries or jurisdictions with low to no taxes, specifically designed to attract foreign investment. And by foreign investment, we mean money the wealthy don't want their own governments to tax. Now you might be thinking, can't we just, make them illegal? And to that, I say, bless your heart. It's adorable that you think that. See, it's not that simple. These tax havens are often intricately woven into the global financial system. Plus, there are perfectly legal ways to use them, like setting up offshore trusts. Don't worry, we'll get to those delightful little legal fictions later, but the point is, cracking down on tax havens is like trying to nail jelly to a wall. It's messy, it's difficult, and you're probably going to make a mess. But here's the thing, just because it's hard doesn't mean we shouldn't try. Because while the wealthy are off sipping pina coladas in their tax-free paradise, the rest of us are stuck here footing the bill. Let's talk about how the wealthy make money simply by having money. It's a beautiful system if you're already rich, and it's called capital gains. Imagine this, you buy a stock, it goes up in value, you sell it, and then BAM! The government wants a piece of your profit. Well, the wealthy have figured out a way around that, and it's as simple as holding on to those assets for more than a year. You see, long-term capital gains are taxed at a lower rate than your regular income. So while you're slaving away at your job, paying taxes on every paycheck, the wealthy are sitting pretty, watching their investments grow and paying a fraction of the taxes. But wait, there's more. They also have this neat little trick called tax loss harvesting, which is essentially using investment losses to offset any gains they might have made. It's like playing the stock market with a get-out-of-taxes-free card. Now let's talk about charity, a noble pursuit to be sure. But for the wealthy it can also be a fantastic tax write-off. We're talking about deducting charitable donations from their taxable income, essentially getting a tax break for their generosity. And it's not just about writing a check to your favorite charity. Oh no, this is next-level philanthropy we're talking about. They're donating appreciated assets, things like stocks or real estate that have gone up in value. This allows them to avoid paying capital gains taxes on those assets while simultaneously reducing their taxable income. Then there are the business expense deductions. Private jets, deductible. Fancy dinners, deductible. A trip to the spa to relieve work-related stress, you better believe that's deductible. And you know what's not deductible? Your daily commute on public transportation, or that new laptop you desperately need for your job. But hey, at least someone's getting a tax break for their private jet's in-flight massage therapist. Inheritance and estate planning. Because death shouldn't get in the way of tax avoidance. Death. It comes for us all, even the super rich, but unlike the rest of us, they've got a plan for that too, estate planning. And trust me, It's not just about making sure their cat inherits their extensive collection of Fabergé eggs. See, when you're worth more money than some small countries, you have to get creative about passing on your wealth without the taxman taking a massive chunk out of it. Enter the dynasty trust. This legal maneuver allows the wealthy to essentially create a trust fund that lasts for generations, shielding their assets from estate taxes for decades to come. They also love something called gift tax exemptions. Every year you can give a certain amount of money away tax-free. But the wealthy, they use this to strategically transfer wealth over time, slowly but surely, like a money glacier carving out a tax-free canyon. And let's not forget about those irrevocable trusts. Trusts so ironclad, so legally binding, that even the IRS thinks twice before messing with them. It's like putting your money in a bank vault, launching that vault into space, and then daring the government to try and collect taxes on it. Corporate structures where businesses go to hide from taxes are corporations, those legal entities that are somehow people when it's convenient, but not when it comes to, say, facing consequences. Well, the wealthy love corporations, and not just because they can name them after their pets or obscure astrological signs. No, they love corporations because they're fantastic for avoiding taxes. We're talking about setting up shop in countries with lower corporate tax rates, also known as corporate inversions. It's like a shell game, but instead of shells, it's your entire business, and instead of a P, it's billions of dollars in potential tax revenue. And then there's transfer pricing, which is a fancy way of saying they manipulate the prices of goods and services between their own subsidiaries in different countries to minimize their overall tax burden. It's like playing a game of intercompany hot potato, but instead of a potato, it's profits. And instead of getting burned, they're getting richer. Taxes. They're like that one friend who always wants to hang out, but instead of wanting to borrow your favorite shirt, they want to borrow a significant chunk of your income. Well, the wealthy have figured out a way to tell those taxes, hey, can we do this later? And by later, they mean potentially never. It's called tax deferral, and it's like hitting the snooze button on your tax obligations. Think of it like this. You have money, but you don't want to pay taxes on it yet, so you invest it in something that allows you to delay paying those taxes until a later date, ideally when you're retired, living on a yacht and sipping umbrella drinks. We're talking about things like deferred compensation plans and certain types of life insurance policies. These are complex financial instruments designed to do one thing: help the wealthy keep more of their money for longer. Let's be honest, when most of us think real estate, we're thinking about whether we can afford the rent this month. But for the wealthy, real estate is just another playground for tax avoidance. First up, we have depreciation. Now, in the real world, things tend to lose value over time. Your car, your phone, your sense of hope after a long day of doom scrolling. But in the magical world of real estate, things can depreciate for tax purposes even if they're actually going up in value. It's like claiming your vintage wine collection is getting less valuable every year while simultaneously selling a bottle for a small fortune. And let's not forget about the 1031 exchange, a beloved loophole that allows investors to defer paying capital gains taxes on real estate sales if they reinvest the proceeds into a similar property. It's like a never-ending game of Monopoly, where the wealthy keep trading properties and never have to pay taxes on their winnings. And finally, we arrive at the pièce de résistance of tax loopholes: carried interest. This one is so egregious, so blatantly unfair, that it deserves its own special place in the Tax Dodger Hall of Fame. Here's the gist. Hedge fund managers, those wizards of Wall Street who make money disappear and reappear at will, get to treat a large chunk of their income, the carried interest, as capital gains rather than ordinary income. This means they pay a lower tax rate than, say, a teacher or a firefighter. Let that sink in for a moment. Now, you might be asking yourself why. Why on earth would we allow this? And that, my friend, is the million-dollar question, or rather the multi-billion-dollar question. The answer, as with most things in life, is complicated and involves a lot of lobbying, campaign contributions, and backroom deals. So, there you have it. Those are just a few of the many ways the wealthy legally minimize their tax burdens. And while these strategies might be legal, they raise some serious questions about fairness in our tax system. Is it right that those who benefit the most from our society contribute the least? Is it fair that the burden of funding essential services falls disproportionately on the shoulders of the middle class and the poor? These are questions we need to be asking ourselves, because until we address these systemic issues, the wealthy will continue to play by a different set of rules, leaving the rest of us to pick up the tab. Don't forget to like and subscribe for more insights.